back to a time when you had an idea for a business. You daydreamed about this idea, you thought about all the good you could do, you thought about how successful your business was going to be, and you got hyped up. And next thing you're thinking is, how do I get the money I need to fund this idea? So you decide to reach out to your family members and your friends, and you tell them about this wonderful idea you have. You explain to them all you plan to do, how you plan to achieve it, and they buy into your idea. They like what you're saying to them. So they decide to fund this project or this idea you have, and they make contributions to your business. This is where the idea of shares come in. You need a way to keep track of how much you've received from different people and like what portion of your business their contributions represent. You give them a certificate or a confirmation showing what percentage of your business they now own. This is pretty much what a share is. A share is a unit of stock. It is a portion of ownership in a company or unit of ownership in a business. So the more shares you sell from your business to people, the more they own of your company. So now you've operated this business for a few years and you want to expand, you want to make this business bigger. For this, you will need to carry out a process called evaluation and an IPO. I'll talk more on these two processes in a different video. Going back to stocks, your small business, which is now a big business, is publicly listed and trading on an exchange. So most countries have exchanges, such as the LSE in London, the TSX in Canada, and in the US, they have the NYSE and the NASDAQ. These exchanges is where people will have the ability to buy and sell shares of your company and trade your stock. There are generally two main types of stock. You have the common stock and the preferred stock, and there are numerous reasons why people buy shares. It might be for diversification, to make sure you're not all invested in just one asset class and to have your investment spread across different asset classes and different products. It could also be for tax reasons. Based on the kind of stock you buy, you might get tax breaks, or depending on how your stocks perform, you might also get tax breaks for those reasons. You could also buy a stock because of the returns you can receive, for instance, in the form of dividends. Over time, as a stock trades, it would go up and down in value, and this might be due to different factors, such as the company's performance. So in the world of investing and finance, people take different positions on different stocks. People have different bets or expectations of what they think will happen. The hope is that the business which you've taken a bet on, or taken a position on by buying their shares, your expectation is that this business will be successful and performs well in the future, hopefully even overperforming your expectations. But it's also possible for the share or the stock to underperform, and it's also possible for the business to go completely bust. Investing in shares has risks. It's always important to do your own research before you invest in anything at all and have a good understanding of the share or the stock you want to buy. This way, you learn more about the business and you get a better sense of what your money will be put to and the future expectations of the company in terms of what its management wants to do or the direction that business is heading. I believe we've covered the basics of stocks. So next time anyone tries to explain anything to you, let them know I was already explained it to you. Bye. See you in the next one.